Hey guys, in this video, if you've come to this place, you've come to the right place for all of your budgeting questions. It is no mystery, no secret that budgeting is at the very core of good personal finance management. And in this video, what I'm going to do is I'm going to walk you through the sources of the information, the documents that you need to collect, how you need to categorize these documents or the information that's in these documents, and what to do about the information that you have so that you can organize it in a way that allows you to see how the decisions that you make on a day-to-day basis result in either a cash surplus, which is where you want to be, or a cash deficit, which represents danger. So, as is usually the case, I will share my screen with you and we will get started. Now, in this example, I have some figurative numbers here, okay? You would obviously go through, and each person's situation is unique. So you're going to have, as a household, whether it's you as a single person or you as a couple of other people, you're going to have different cash flows and different cash inflows and cash outflows. And you're going to have a different beginning cash balance. That is the balance of cash that's in your bank account right now, than this example. But I use this for illustrative purposes. You can increase the categories of inflows if you have more inflow sources. You can decrease if it's purely you go to work and you get a paycheck and you come back, then you'd only have the one. And then likewise with the cash outflows, you'll have different ones. You may have a mortgage, you may have many different cash outflow categories. But for demonstration purposes, this is what I've decided to focus on, okay? So the question is, how do you come up with these numbers in the first place? I mean, it's one thing for me to just give you a demonstration here and say, okay, these are the numbers, but how would you go about doing this? So what you're going to want to do, and it is a little bit of a exercise, and hopefully you don't check out at this point, but you're going to want to gather source documents. What do I mean by source documents? I mean things like your bank statements, things like your credit card statements. If you use a line of credit to make purchases, rather than just transferring the cash into your account to cover shortfalls, then you would want to bring out the line of credit statements as well. Some statements that can be tricky is you may have an Apple or a PayPal line item in your bank statements or other sort of catch-all line items, and you don't really know what those things are. In that case, you're going to have to go into, say, your Apple account, and you're going to have to see what is it that I paid for, or what subscriptions do I have through Apple that are just showing up as Apple on my bank account. Same thing with PayPal. You may have expenses that go through PayPal, and then it shows up as PayPal. It's not really PayPal. It's something else that you're spending your money on, okay? So there is a little bit of investigative work that has to be done, but you have to gather all of those source documents. The other thing that's critical is if you use cash to make purchases on anything, then you have to have receipts. If you don't, then you won't get a realistic idea of what you're spending your money on. And so a lot of personal finance coaches will say, you know, take receipts if you're using cash for everything, or just use your debit card or your credit card so that there's a record that you can then track. Okay, so once you have all of that information, you're going to be able to take a highlighter or a pen or whatever, and you're going to categorize. You're going to go through like a month at a time, and you might need a couple of statements because of the timing of the statements. It doesn't make it easy. It's not like you get, you know, March the 1st till March the 31st. You sometimes have to use a couple of statements to piece it together. Okay, I don't know why they don't make it easy, but it's just the way that it is. Okay, so you're going to go through and you're going to get potentially pay stubs, You've got to be careful around your frequency of pay, because if it's bi-weekly, then your monthly amount needs to be adjusted for the fact that that you're not going to get paid the same amount every month. So you got to make that adjustment. And that's important if the cash flows are tight. It's less important if the cash flows are not very tight. Okay, you can just sort of use your annual amount and then divide it by 12 to get the monthly amount. Okay, and one last thing on that: if you're getting paid bi-weekly, there are 52 weeks in the year, so 26 bi-weekly periods. So whatever your bi-weekly amount is that gets deposited into your account, you have to multiply that by 26 to get the annual amount, and then you have to divide that by 12 to get the monthly amount. Okay. In this case, I've got interest income. Where does interest income come from? It may come from any fixed income or savings accounts or whatever the case is. In this case, I've assumed a certain portfolio that gives 3% on $80,000. Okay, and 3% of 80,000 is $2,400 per year, which is $200 per month. Okay, so that's where the interest income comes from. Obviously, you want to be saving so that you can have things like interest income, but if you don't, then you obviously wouldn't include that. Side income, that can be from whatever sources: government benefits, other income. The idea here is when you're looking through your source documents, you want to find all of those different sources of cash inflows, what increases your bank account. Okay, then you go into the other side, which is the cash outflows. You'll have things like rent. Groceries can be a difficult one to figure out how much you're spending on because it fluctuates. So what you would like to do is maybe take 2 or 3 months worth of history of grocery spending and then divide that 3-month period by 3 to get a realistic number. Ultimately, what you want is a number here that you think is realistic, that you can stay within, that you don't spend over, that is targeted toward groceries. And if it's $400 on a monthly basis, roughly speaking, $200 per week would be what you want to spend if that's the frequency that you buy your groceries on. Okay. Dining out, car payments, etc. Okay, so you're going to go through your financial statements. You're going to find the first line. You're going to use that as a bucket, and then you're going to find everything else that's like it. Okay. Or you can exercise some judgment and say, in the case of gas transportation, say to yourself, how much do I spend on gas and transportation each week? Okay, or every couple of days or whatever. If you do it weekly, then you just multiply that number by approximately 4, and that becomes what your monthly budget amount is. And then you have to monitor to make sure that you're not spending more or less than that. Okay. Now, the goal here isn't necessarily precision, but it is realism. And you want to be relatively realistic with the projections that you're making. This is a forward-looking document, okay? So you want to be careful about the projections that you're making, which is likely going to be based off of past information and you exercising your judgment, okay? Just make sure that you don't miss big categories because that will have bad implications on your budget. All right, so what do we do with all this information after we've gone through the sort of discovery and collection process? Well, we want to analyze it, and we want to analyze it through a model, and the model is our cash budgeting model. So the cash budget, as seen here, is a model that shows how your cash position is going to change over time. In this case, we have it set up as a monthly cash budget. So we have from January to December. And what I want to do is I want to go through this. Now, you don't have to do it monthly. You could do it annually, in which case you'd have, this year, the next year here, and you could see sort of how your cash position changes over time given the behavior that you're using basically how your cash is coming in and going out. But in the longer term, jobs change, a lot of things change about your cash situation. So usually it's a 3 to 12 month. If you're doing 3 months, then it's a rolling basis, or 12 months if you want to see the next year in review. All right, so where do we start? We start at the top here with our beginning cash. I like to keep all of my assumptions or inputs on a separate tab so that I can reference those. And that way, if I change those assumptions, they just change in the actual model, which is essentially what we're building here. So if I want to find my beginning cash, this is the starting point. I just pull that beginning cash number and I have $1,000. For my salary for person 1, 2, interest income, net income, etc., I do the same thing, right? So equals the salary here, enter, and I can just copy and paste all of those down because the format is the same. Okay, so if I do that, then I get 3,200, 2,800, 200, 300, 200, and 100, which matches my assumptions here. Okay. Next, I want to sum up all of these income sources. Now, be careful not to sum up the beginning cash. It may be helpful if you sort of put a row, so you can insert a row here, and then you can just say sort of cash inflows to sort of section it off to make it cleaner. And what we want to do is we want to sum all of these. So we can do this by either clicking the auto sum button. Okay, and the auto sum button will grab all of the ones that are above it. That's the easiest way. Or you can just type in equals sum and then make sure that you select all of the right ones. So we've got total cash inflows here of 6,800. Next, we want to move to our cash outflows section. So I'm going to, again, separate these just to keep it clean. Cash outflows. Okay, and where's the rent? The rent is over here. And again, I want to copy all of the information from the assumptions tab over here, and I can just either copy paste, or I can hold down this little square, copy it all the way down, and it brings everything over. Again, if I want to sum up all of this, all of these values, I just click the sum button and just make sure that you're only selecting the information that you want. Press enter, and we have 6,400 worth of cash outflows. Now, the change in cash is the difference between your cash inflows and your cash outflows. So this, we're going to use the formula equals, we're going to click our total cash inflows, we're going to subtract our total cash outflows, and that is going to give us 400. And if you've looked at the debt reduction videos that I also have in this channel, then you'll see that I used 400 as the excess cash that can be used to target debt that we have. And that's also where the debt payments, the minimum debt payments, come from here. Okay. So now we have the ending cash, and the ending cash is just going to be this beginning cash value plus the change in cash. Okay. So equals the beginning plus the change in cash. Now, this is where things get a little bit troublesome for people in their personal finance. If the total cash outflows is greater than the total cash inflows, then the change in cash is going to be negative, and you'll see that your daily cash balance is steadily decreasing, and you want to change that around so that your ending cash balance, which will become your beginning cash balance of the next period, is on a upward trajectory. Okay, or a flat line, and I'll show you the flat line instance in a second. Okay, so 1,400. Now, the ending cash balance of January is going to become the beginning cash balance of February. So we're going to select the ending cash balance cell, and that becomes the beginning. So we start the month now with 1,400. So now we just have to copy all of these cells over because we're not assuming that any of this is going to change. Now, note what I did there. Okay, I copied and pasted this, which is referenced here. And that's because I didn't anchor any of these. So I have to go back and I have to anchor each one of these assumptions, each one of these income sources rather. And this may seem like it's taking a little bit of time, but it ends up saving us time when we can copy and paste. Okay, and the last one. Okay, so now if I hold this down and bring it over, it's just the values. Okay, going to want to do the same thing here. Okay, so that's good there. And then we copy and paste it over all the way. And just make sure that everything looks good on that first row or that first column and the second column, and everything looks the same all the way across. Okay, because this is a formula and it's not anchored to anything, we can just drag and drop that one across. We can drag and drop the sum formula across. We can drag the change in cash formula across, and we can drag this formula across. And the last thing that we need to do is we need to drag the beginning cash flow across here. So at this point, you're done. You can see that your cash position as a result of being in a positive, a surplus of 400 each month, you can see that your cash position, your beginning cash increases by $400 per month. Now, if you actually use that 400 and you target a debt facility, then you would want to include the extra 400 here, okay? And if you do that, look what happens. Your total cash outflows goes up to 6,800. Your change in cash goes to 0. And if you copy and paste this all the way across, your ending cash balance is always going to be the same, and your beginning cash balance is always going to be the same because you're using that excess cash toward debt payments. Now, you may say, well, I'm not really making progress if I'm doing this, if I'm running a balanced budget. Wrong. You are making progress because you are reducing your debt faster, which is increasing your equity. The difference between your assets and your equity is your net worth. So the faster you can pay down debt, the higher your net worth will rise. Okay. So hopefully this example was helpful in building your own cash budget. You now have the tools and the knowledge available to go look at your source documents, categorize it just as I've categorized it here under the assumptions, and follow along with this video, and you'll have a tool that really informs the types of decisions that you can make. And you can make your adjustments as you see fit. Ultimately, the more income that you have, the more inflows, and the less outflows, the more surplus you have to either target debt or save and invest. If you've liked this, be sure to like it, hit subscribe to stay up to date with all of the new content that I create, and help me grow this channel so that I can reach more people and give more people this advice.